Hi, I'm Vi, and it's time to answer a question about one of the common tools that's used to evaluate whether an investment is cheap or expensive. And I must stress that this is only one tool, but it's so common and referred to so often that you might be feeling stupid if you're not really sure what they're talking about. So let's dive in. It's the price-earnings ratio, or in short, PE. So what are they talking about? And when I say the word ratio, please don't have your eyes glaze over. I'm going to keep it simple, and we're not going to get into a lot of complicated math. So what we're talking about is the relation between the price that the shares are trading at and their earnings and what they're going to earn in the future. So in general, as a company makes more money, their stock price rises, but the market's always looking forward and looking to what they're going to make in the future, because of course you're wanting to know that you're going to make more money in the future as the stock price goes up too. So it's rising and falling on those future expectations. And so what we see is that PE ratio goes up and down with the stock price. So some of the standard older industries, like the banks, they're not growing their earnings as quickly, so they're going to trade at a lower PE. And then growth companies in new industries, and particularly technology, they're going to grow and are expected to grow at a much faster rate because they're a newer industry with newer technologies. So that's keeping it simple. But we're not even going to get into talking about the companies that aren't even making money yet. So that's a whole nother matter. But what we want to talk about is separating investors who are looking at the PE ratios in a traditional way versus the speculators who are saying, well, those rules don't matter. Things are different now. You might have heard that. So right now there are established technology companies trading at a PE range of 26 to 36 times earnings, which would be considered very expensive for an older industry like the banks, because they're trading currently around 13. But right now there's a market darling trading at, get this, 1,300 times. So the price is trading 1,300 times their current earnings. So what that is telling us is that the market expects those earnings to grow dramatically. But 1,300 times? Something to question. So when I see these kind of things, my mind goes to the early 80s. And I still remember Japanese stocks trading at triple digits and people going, it doesn't matter because accounting is different in Japan. Then what happened? Crash. And the dot-com boom. Again, triple-digit PEs. That doesn't matter. The internet's going to change everything. Things are different now. Crash. So I'm not saying that the market's about to crash. I'm certainly not pulling out a crystal ball. But what I am saying is that when you see a company that's trading that out of line, you have to ask yourself, are you investing or are you a speculator? In other words, are you gambling? Because there's a big difference. So when you hear that phrase, it doesn't matter if things are different now, it's a time to pause and just reflect. So there's our stupid question for today. If you've got one, please let me know. I'd be happy to address it. Thanks.